Well, if you've made it this far, obviously you are very interested in options, and let us discuss options strategies. Now, these are on the Series 7, and you really have to know them. Plus, you also want to be able to explain to people why they want to stay away from them. But who knows? At the very end of this presentation, we'll discuss a couple of option strategies that yours truly may do someday, probably won't, but may make sense for some people. So let's get started on slide 31. Options strategies. Speculating. Now, these are from the book, right? You will often hear, if you feel the market price of a particular stock is going to move up, or if you anticipate a drop in price within the next 6 months, it is a highly risky investment. No, it's a speculative strategy, but it may be suited for the more speculatively inclined. The flaw in these statements, in these arguments, is this. There has never been a successful method to predict stock prices in the short term. There are lots of unsuccessful methods. You may feel or you may anticipate that the price will go up or down, but that doesn't mean it will. It is not investing, it is gambling. Speculating. Plus, you may be correct, but your option may expire before you are proven correct. Yeah, so I have already told you stay away from these things, but let's take a look at some strategies. Hedging. Hedging is a transaction or a series of transactions made to reduce the risk of adverse price movements in your asset. You can think of hedging as an insurance policy. Although insurance can be useful in some circumstances, it ain't free, folks. Insurance companies don't give it away. You pay for the insurance via the price of the options and the commissions. Investors can use hedging strategies when they are unsure of what the market will do. A perfect hedge reduces your risk to zero, except you got to pay for it, right, through the cost of the option and the commissions. And we're going to see hedging again in our next chapter on futures, where it actually does make sense, but not for you and me. It makes sense for large producers and consumers of items. Slide number 33. Here's an example. You own 100 shares of Butterfly.com. You've heard of them, right? And it is currently selling for $50. You are afraid the price will plummet within the next 3 months to $10. So what do? You purchase a put at $50. No matter what happens, you can sell the stock for $50, but only until the option expires. Then you must go out and buy more insurance and buy another put option. This is called a protective put. Insurance, as we've said, is not free. Using options as insurance is one way to keep your broker very happy. If you're so sure the stock's going to fall, just sell it. I mean, if you wouldn't buy it now, maybe it's time to sell it. Why play with these options? Slide number 34. A straddle. A what? A straddle is the simultaneous purchase or sale on the other side of the contract of a put and a call on the same underlying financial asset. What? You're bullish and bearish at the same time? Yeah, that's exactly what you are. You don't care whether it goes up or down. You just care that it's volatile, that it goes up and down quite a bit in either direction. If the price is volatile in either direction, up or down, you will make money. Of course, you've got to pass the break-even point for both purchases. And you got to pay the commissions. If the price is not volatile, then you would take the other side of the contract. You would sell, make the straddle, and hope that the price does not change greatly. So you see what you're doing here? You don't care which way it goes. You're just hoping it goes big in either direction. And if you're on the other side of the contract, you're hoping it doesn't. But guess what? You got to pay 2 commissions at the same time. Oh, your broker's going to love you. 35. Here's an example. Butterfly.com. You remember they make blue steam, right? The left-handed smoke shifter. I don't know. Now they're doing marijuana. But Butterfly.com is selling for $50, but its price is extremely volatile. You purchase a call at 50 and you purchase a put at 50. The price of the call is $4. The price of the put option is $5. Now, no matter which way the price goes, one of your options will be in the money, unless you're unlucky enough to have it land at $50 exactly on the day it has to expire. But the call cost you $4, the put cost you $5, so the price has to move at least $9 either way before you break even. And we did not include the cost of the commissions. You paid 2 commissions for the straddle, possibly 1 more for exercising the option or selling either option that became worth a whole lot more. It's a brilliant strategy, don't you think? No. It just gets you hooked that much more on gambling. And it gets better. Wait a minute. Here's a spread. The simultaneous purchase and or sale of 2 or more options with different strike prices and or different expiration dates. What? Yeah, you just start throwing these things together like one from column A and one from column B, and we'll turn it upside down and do one from column C. So that's an example. The stock's selling for $50. You buy a call at a strike price of 50. You sell a call at a strike price of 55. You paid for the call at 50, but you got paid for the call at 55, and if the price rises, you'll make some money. Do you see where this is going? The brokers are just trying to get you hooked on gambling, and they're giving you all different types of options to do it. The possibilities are endless, and so are the commissions. But if you take the Series 7, right, they're going to ask you about this. So you got to learn it. Slide number 37, selling options. Now here, dear students, this is the option strategy that yours truly, if I ever did start trading options, would start. But that doesn't mean you still can't lose big, folks. You still can lose very big. Exactly. It's called selling an option or writing an option or making an option. I hope you figured that one out by now. You see, selling options allows the individual investor to play the part of the casino. You become the Las Vegas casino, and the option buyers are betting against you. And as we said, more often than not, the option writer, the option seller, the option maker is right, because most options expire worthless. Have I mentioned this yet? I know some people say it's not true, but it is. No matter what happens, the option seller gets the buyer's premium, the price of the option. But look, folks, it doesn't mean you can't lose big. You can. Exactly. You can still lose big in this situation. Because the price, for example, could skyrocket for whatever reasons. Happened before. It doesn't happen often, but it's happened. And if you're the maker, the writer, the seller of that option, you could lose a ton of money. Slide number 38. Selling options with covered calls, covered options, and naked options, uncovered options. Covered options are options written against stock owned or sold short, and we talked about that in the first presentation, where we show it in the face-to-face class, where we have somebody hold up a sign that says, "Hey, I'm the option seller, and I could lose a lot of money unless I'm covered," and we'll see how that works. If you're naked, it means you're not covered, and you could lose a ton of money, right? So we'll see how that works. Those are options written on securities that are not owned or sold short. What does that mean? That means we're looking to buy it back anyway. We're going to buy it back, so we have to buy it back. And we'll see that in the next chapter. Yeah, it's another way to lose money quickly, or make money if you're lucky. The amount of return to the option writer is always limited to the amount of option premium received. But the loss can be substantial, even unlimited. Now, they won't let you lose an unlimited amount of money, but theoretically, it can happen if you have a naked call, an uncovered call. Well, what are we talking about? Let's get more specific. A covered call is actually not a bad option to choose, no pun intended, not a bad strategy. It really isn't, folks. It's the only options transaction that is allowed in an IRA, by the way. And so how does it work? Well, you own the stock and you're considering selling anyway, or you're thinking of selling the stock, right? So instead of selling this, but you don't really want to, you're not sure, you write a covered call and you receive the premium. So you get money in your pocket, folks, and they can't take that away from you. When you sell the option, you get the premium, whatever it is, $1 times 100. Remember, you have to always multiply by 100. $3 times 100. Now, if the stock jumps substantially, the stock will be called away from you. You're going to be forced to sell. So, oh well, but you were thinking of selling anyway, right? If the stock price stays the same or goes down, the option will expire worthless. And then you can do it again. You could write another covered call. But in either case, you get to keep the premium. Well, what do you think are the downsides of this? Well, what if the stock jumps crazily? You wrote an option at 50 and it jumps to 90. Oh, well, you were going to sell anyway, right? And so you sold and you got $50 plus whatever, $2, $3 per share that you got from the option premium. What if the stock price plummets? Well, you should have sold, right? You see, so it's not without its risks, but it's a fairly low risk way to make money because you have the shares. If you wrote the call, sold the call, made the call, they all mean the same thing, at 50, but you did not have the shares, if the price jumps to 100, what do you have to do? You've got to go out and buy shares at $100 a share and sell them at 50. So you see, you really are in a very precarious position when you become the option writer, unless you're covered. If you're covered, cool. I have the shares. I can deliver them to the person who's going to call them away from me. And this strategy is one of the 2 option strategies I personally would ever consider, folks, and I've never done it, and I probably never will, so it doesn't matter. Slide number 40. Here's an example. You own Butterfly.com, and it's currently selling for $50 a share. Well, you bought it at 40 and you want to sell. So you write a covered call at 55, and you receive $500, say, since the premium for a $55 call is currently $5. So you get $500 in your pocket. You have 100 shares, remember. And a $5 contract would mean $5 times 100. If the stock price jumps over 55, well, it's going to be called away from you at 55. But it's as if you sold it at 60 because you get the $55 per share for the shares and you get the $5 per share for the option. And if the stock price stays below 55, well, you can write another covered call. Pretty cool? I think so. I think it's cool. I've never done it, but I think it's a great way to make some extra money. It allows you to juice, so to speak, or get a little extra cash out of your stock that you're thinking of selling anyway, right? If you just sell it, you get the price of the stock. But if you sell the option, then you get the price of the stock plus the option premium. But as we said, what if the price plummets? You should have sold it, right? So there are disadvantages. And if the price goes up to 100, well, you were going to sell anyway. Slide 41. Here's the other option strategy that yours truly would personally consider doing, has never done, probably never will. And that's a naked put. Now wait a minute, Piano. Didn't you tell me that naked transactions, uncovered transactions can be very dangerous? Well, yes, but not if you're covered in the sense that you have the cash. You see, then you really aren't naked. If you have the cash and you were going to buy it anyway, you're considering purchasing a stock and you have the cash. So in that case, you really are covered, but the regulations say you're not, even if you have the cash. The only way you can be covered in a put transaction is to have the shares sold short. Huh? Wait till we get to the next chapter, okay? It means you have to buy them anyway. You have to eventually buy these shares. So they say, okay, you're covered because you have to buy them anyway. But let's say we were thinking of buying them, but we're not sure. But we have the money. Now, I think this should be allowed in an IRA. If you're going to allow covered calls, you should allow naked puts as long as the person has enough cash in their account. And you can't let it get below that amount. So you write a naked put and you receive the premium, right? So you get whatever the premium was. That's money in your pocket. They can't take it away from you. If the stock price falls substantially, well, the stock's going to be put to you. You're going to have to purchase it. But you were going to purchase it anyway, right? You were thinking of purchasing it anyway. If the stock price stays the same or goes up, right, the mirror, unlike the call, if it stays the same and goes down, if the stock price stays the same and goes up with a put, the option is going to expire worthless. You can write another naked put. You get to keep the premium. You see? Yeah, right. So this one's actually pretty cool if you have the cash. If you don't have the cash, think about it, folks. Yes, if that stock price goes to zero, you still got to buy it at $50. So let's take a look at slide 42. Here's our example. You are currently considering purchasing butterfly.com. Don't do it, by the way. And it is currently selling for $50, and you have the cash. Now, how much do you need? 50 times 100, right? You need $5,000. You write a naked put at 45, and you receive, say, $300. Since the cost of a $45 put is currently $3. So you're going to get $300 in your account, and that they can't take that away from you. If the stock price falls below $45, the stock will be put to you at $45. But it's as if you bought it at $42 because you paid $45 for the stock, but you got $3 from the premium, from the price of the option. If it stays the same or it goes up, well, you can write another naked put. So again, it allows you to make money from a stock that you want to purchase, but you're not quite sure. What are the disadvantages? Well, right, it could go to zero. Or it might keep going up, in which case you're never going to buy it. Oh, well. So these are not without their disadvantages. And as I said, I'll probably never do them. But that doesn't mean you shouldn't, or at least understand them, especially if you're going to take the Series 7 and get into the industry. Cool. I know options are confusing. One more. We have one more presentation to look at, and that will cover employee stock options, and then a quick look at warrants. Warrants? Yeah, it's like an option, like a call option. Okay? So those of you who have slogged this far, congratulations, and we are very proud of you, and we want you to be awesome so you will impress your friends and influence people with how much you know about gambling. I'm sorry, speculating in options. See ya!